Very good evening to all of you. I hope I'm audible, loud and clear. So, a very good evening to all of you. We'll be starting the webinar now. So, first of all, thank you all for joining the webinar today. I hope all of you are doing well. Thank you all. My name is Akshay Udeshi. I'm Senior Manager ETF at Mirae Asset Mutual Fund. And joining me today is Mr. Vishal Singh, Assistant Vice President at Mirae Asset Mutual Fund. Over the past few days, global headlines have once again reminded us how quickly geopolitical risk can resurface, with rising tensions in the Middle East creating fresh uncertainty across global markets. But if we take a step back, this is not an isolated event. Over the last 3 to 4 years, the global landscape has witnessed series of geopolitical conflicts, right from the Russia-Ukraine war in 2022, lately followed by the US attack on Venezuela, and now the continuing tensions in Middle East. So whenever such events unfold, financial markets tend to react swiftly. Over the last few sessions, global equity markets across both developed and emerging economies have seen volatility and corrections. Even in India, we saw Nifty 50 correcting from around 25,500 levels to roughly 24,300 levels yesterday. At the same time, traditional safe haven assets saw strong movement. Earlier this week, gold prices in India briefly touched 1.75 lakh levels per 10 grams, while silver prices they settled around 2.65 lakh per kg. This shows the heightened investor demand during periods of uncertainty. Another interesting trend during the periods of this geopolitical tension was the rally in global defense stocks. Companies such as Lockheed Martin, RTX saw gains as investors vouched on them, anticipating higher military spending amid escalating conflicts. This again highlights how certain sectors like defense can benefit during periods of global uncertainty, even when the broader markets remain volatile. Against this backdrop, investors are now addressing an important questions. How can their portfolios adapt to a world where the geopolitical uncertainty is becoming so frequent rather than exceptionals? So this is what we are going to discuss today, how themes like defense, gold, silver are becoming important components of portfolio during these periods of geopolitical uncertainty. So with that context, let's Vishal, let me begin with you. So from a market perspective, how do you see global geopolitical developments influencing investment trends today?
Sure. Thank you, Akshay. First of all, a very warm good evening to all the attendees who have given their time. Probably we are, if we have to look at last half a decade, we have been living in an unprecedented time. The amount of geopolitical escalations that we all have seen, something like, if I have to say that we would have seen more happening in last 5 years than what has happened in over 5 decades. Now, addressing to your question, Akshay, before all this began, just if we take a week back, what is happening across the globe? Domestically, your earning numbers have been relatively better compared to what it was envisaged. In case of Nifty, out of 50 or your 46 odd numbers are companies have delivered better than expected EPS as well as sales projection. In fact, if you look at the RBI report that talked about October to December for 11 consecutive quarters, your revenues specifically from a non-financial companies are first time they have crossed a single digit. In fact, they have more than 11%. That's what the report talked about. If you look at overall India INC in terms of earnings, where we are out of 5,000 listed odd companies, 4,483 companies have declared on YOY basis. Revenues are up by 14%, gross profit is almost 13%, net profit is almost 12%. Specifically, if you look at mid caps, again, revenues are clogging 14.79, gross profit is around 14.17, net profit is 3.87. So largely what was happening, the conversation which was moving around, anchoring around earnings, for good or bad, that conversation has taken a hit back. And now, of course, everything is pointed through what is happened specifically in the last week. Firstly, if you look at right now, I think it will be too early to comment of how the market is going to pan out. The situation is going to remain fluid and dynamic, and people have to watch out. Why this is very important and critical, I think most of you would have read the Persian part, specifically the Strait of Hormuz. Almost 20% of global oil goes through that. India, which exports more than 85% of oil, is more susceptible to the blockage happening in those part of the sea. Of course, it's a war scenario, but it's also a logistic nightmare that has happened. And why it becomes very critical is crude oil, because India being an importer, ultimately, if you look at in July 2025, the members of the RBI, of course, the central bank did not vouch, but they had published a paper how a 10% increase in crude leads to 0.2% increase in the headline inflation. In fact, that is something very similar to what is expected in the US as well. Now, everything hinges on two factor actually. If it is something very similar to Gulf War, where it was slightly short-lived and the implications were not cascading, at that point in time, if it happens something of that scenario, I think most central banks right now will be in wait and watch mode. What rise in crude oil prices does, firstly, across all the countries, the CPI basket, which is made up of a significant proportion, is attributed to energy. And see, intuitively, if your crude oil prices are increasing, your prices for petrol, diesel, your railway wagons, etc., which are going to take a carriage cost, so there is an indirect impact. What happens? You have a supply side shock. So most of the time, inflation can be broadly divided into either a demand side shock or a supply side shock. This will predominantly across the globe end up giving a supply side shock. But for that to happen, I think we'll have to wait and watch how long the geopolitical tension or the war that has started in the Middle East last. Now, the scenario is if it lasts for more than 5 to 6 weeks, you are looking at a detrimental impact if it lasts more longer than what it has. So, for instance, if we go back and take a cue from the history, the Russia-Ukraine war in 2022 at the start, that lasted for a very long, right? And that point in time, crude oil almost jumped 30% high. In fact, most central banks increased their rate of interest to avoid the supply side shock. So if it is of something of that sort of nature, I think you're looking at potentially, wait and watch mode coming from central banks. And this is a lot dependent upon how the US Fed looks at it, right? And for the good or bad, this is all coming at a conjuncture when you have a new Fed chair being appointed in the May. So there is a lot of uncertainty in the market. I think predominantly in terms of geopolitical point of view, wait and watch is what the central banks are also going to do. However, what it has happened is that a lot of rate cut expectations that were being talked about across the markets, I think those have a lot subsidized from what they can be. Now, for investors, what you rightly pointed out, something is that there is a need to look at structurally towards the precious metal, specifically gold. Similarly, what you pointed out about the defense that we can discuss more in detail. But more importantly, now for all those long-term investors, right? Not the traders, we are talking about long-term investors. So if you look at after yesterday's correction, this is predominantly for the first time, Nifty 12-month forward PE is something somewhere around 19.4, whereas its 10-year average is around 20.4. So predominantly for the first time, the valuations, most of the time the valuations were hovering around 21, 22 p multiple with an average of 20, right? But for the first time, because of the correction, your multiples have fallen around 90.4. So I'm not saying it is a scream buy market, but it is a lot more investable in terms of a valuation perspective compared to what it was a couple of months, couple of quarters back. Your earnings have been good, but of course, a lot more will be dominated by a top-down approach rather than the bottom-up approach. I think the macro geopolitical will continue to guide. Now, in terms of precious metal, what you have seen is a peculiar trend. So generally, what will happen is, I think, predominantly from gold specifically, if the risk of inflation, expectation of inflation continues to exist for a long, then we can see predominantly a rise coming in the prices of the gold. But again, it has to be coming from the incremental risk to the real yield. Now, second point that I wanted to talk about is that there's something, if you would have seen a couple of days back, in fact, gold crashed, silver also crashed 8%, right? So there was a liquidity call across the market when your crude and dollar both went up. Crude going up predominantly will make dollar relatively more strong, but largely it also depends upon how the interest rate navigations happen. And at that point in time, the fact that in my vocabulary itself, there's so much uncertainty, it automatically calls for the asset allocation from the investor's perspective and making some allocation to precious metal. And of course, we can look at defense in more in detail.
That's a very interesting insight, Vishal. So, Vishal rightly pointed out that we have delivered a very decent quarter of earning compared to the last four quarters that we had seen in 2025. But at the same time, commenting about the war, it's very early. We are just 3 or 4 days into it. But India, being a oil importing nation, yes, crude oil always possesses a big threat to us. But when we saw markets correcting on this, like early there this week, we saw that majority of the sectors in India took a beating, whether it be construction, whether it be autos, mostly which have more global exposure, took or logistics heavy took a beating. But there was again one sector that shined out, and we have seen this trend, historically, and that's defense. So when it was Operation Sindoor, we saw defense rallying. During the Russia-Ukraine war, there was the defense sector that was rallying. So whenever there is the geopolitical uncertainty, we'll be seeing defense stocks taking a rally. And governments all over the globe are now increasing the defense budgets. So, do you think, Vishal, that defense is now becoming a structural investment theme rather than a tactical play? Because the geopolitical environment, I believe, has changed a lot in these 5 years compared to what it used to exist back to it 2 decades ago.
Sure. I think, Akshay, before that, before COVID, we were predominantly living in a peace dividend regime. If I have to categorize it as, where peace was the dividend that most nations were looking out for. If we have to look at it in the context of financial, that you're just investing, you're looking for the laid back dividend, and that dividend was peace. But after this 2022, the escalation that has happened, predominantly you look at NATO spendings that have been talked about. The Hague Conference in June 2025, NATO members talked about making defense expenditure almost 5% of their GDP, right? And now I think where we are entering is predominantly in a zone, or I would say a decade of a multi-year rearmament. What do I mean by multi-year rearmament? Is that we may or may not see wars or geopolitical, escalations being coming through again in the going decade. But what will happen? What has history taught us, specifically last 5 decades, is that world is moving more towards a polarized nationalist agenda rather than rather than a globalized framework. So that reduces when you have that kind of a thesis that is moving across the nation, that everybody wants to protect their own interest first rather than looking at the global whole macros. I think every nation, no matter how small or big, they will end up investing heavily in upgrading their entire defense, armaments, etc. And I think, needless to say, see where India is probably, I think it doesn't need more introduction than what we all are, 340 people here, as well as the entire nation knows that we are very more susceptible on both sides, right? On the east as well as west, across that we are covered across with the nations who are more hostile to us. So we have to predominantly invest more. So from that perspective, if you see across the globe, what you talked about, the example of Lockheed Martin, etc., there has been a structural re-rating of defense stocks across the globe that has happened, right? So it's not that your Indian defense stocks are moving just upwards across this stock. If you look at in terms of P, in terms of valuation, your defense stocks, look at Dow Jones, US Aerospace and Defense Index, look at stocks 60 euros, Euro Defense Index, all of them have structurally re-rated, which means your countries are moving towards more, first, reduce the import dependency. Second is indigenization of a lot of these armaments, right? And if you look at the India specifically, India had published a 5 list of positive indigenization list. 74-75% of imports that we used to make have already been indigenized. And where we are, and this is very critical, right? Right now, India is spending roughly around 1.7 to 2% of its GDP. Now, if you look at NATO's commitment in this Hague conference of 2025, all of the NATO members are pointing towards 3 to 5% of GDP. So, from that perspective, if we are expecting India to be a certain X trillion economy, and if we have to match that around 3% of GDP, there's a huge potential scope which is available for the defense contractor. And what has happened specifically post 2014, the private manufacturers have had a lot more order book visibility coming from the government. In fact, if you look at the government's target for 2029, they are targeting around 50,000 of export, around 3 lakh of defense production, which is already, as of March 2025, around 1.5 lakh. 22% of them is coming through, private manufacturers as we speak. And then you look at structural prioritization, right? It's not a tactical call. I mean, our defense budget has increased from 2.5 lakh crore in FY14 to 7.85 of almost 15. It is the largest allocation made among all ministries. And then you look at capital allocation for modernization, it stands around 2.1 lakh crore, as I talked about, right? In fact, in February 2026, Defense Acquisition Council, they have cleared a project worth 3.6 lakh CR in a single round of approval, which is almost a 46% of our defense budget. We talked about it, right? In fact, if you look at in this budget itself, DRDO budget was increased to 29,100 CR, and of this 17,000 is specifically towards the R&D. Defense acquisition policy, which is a draft policy, it has been formulated, which I talked about, the positive indigenization list 1, 2, 3, 4, 5. This has been published, and what it makes the life of a lot of this private manufacturers, that they have a multi-year visibility of order books, and this is very critical, right? When you are having structural re-rating, yes, there is a geopolitical element that is contributing, but where is the order book looking at? So, for instance, if you look at certain Indian manufacturers for the light combat aircraft, they have received a lot of MRF fighter jets, Astra MK2 missiles. In fact, a lot of drone which is being used. Largest drone manufacturer is a private company manufacturer. In fact, in India, if you talk about the drones that were used in Operation Sindoor, were manufactured in the Kanpur, Kamikaze drones, etc. So from that perspective, I think definitely you have a structural theme coming in. And second point is, if you look at major allocation, most investors, we did this study that on an average, your weight to defense stock in an actively managed portfolio, and which is rightly so. See, nobody wants to deviate significantly from the benchmark. Most of your defense falls under the capital goods ambiguity, and if you look capital good as a representation in Nifty 500 is less than 10%. So that's why a lot of these defense companies do not have a decent representation coming across a lot of your flexi cap, large cap, multi cap categories, right? So in fact, if you look at the pure play defense manufacturer, on an average, they have 1.5% weight across most of the actively managed. So in terms of representation, forming a part of your satellite portfolio, I think defense can definitely, because of the structural theme where it is, and also it is a non-overlapping theme with your existing structure where you are looking at. So from that perspective, I think definitely the defense is a theme that is going to stay with us specifically for next a decade or so.
That was a very interesting insight, Vishal. So Vishal rightly pointed out that given India's geopolitical positioning, we being surrounded by hostile neighbors all across, and our spending being around 2%, where the global spending average is around 3 to 5%, India's defense segment has a huge runaway in the coming decade. At the same time, the Vision India Defense Vision 2047, the budget outlay straightly shows that government is going to push the defense segment in the coming time. What is again interesting to know that even private players are now having a good amount of participation in this segment, which was primarily PSU led in the past decade. So I believe that in the coming time, a private plus PSU defense portfolio is going to some that is going to that is some going to pan out in the coming future. And at the same time, if we compare ourselves with the global players like in US, majority of the private companies are the ones that are leading in defense. So I believe that defense in the coming time is a good structural theme to look at. So while defense reflects the growth side of geopolitical developments, investors have historically also turned to certain assets during these periods of uncertainty. For example, gold, Vishal. So whenever there is uncertainty rising, we see that investor tend to rush towards gold, and that has taken place across like in the past 2 or 3 decades. And if we talk about gold, currently gold has been recently trading. It's near its 52-week high. So what role do you think that gold should play in an investor's portfolio like during this uncertainty, and what kind of allocation they should look at?
No, I think apart from the structural realignment that we are looking at specifically towards defense stocks, I think gold is something. I think firstly, what happens is there is an immediate shock, and that's what we saw about it right across the globe in terms of uh, immediately when this news came out of the war, gold moved up. And then, of course, you saw gold getting squeezed also, to be very fair, because your dollar went up. So, firstly, foremost, I think categorically post 2022, one thing structurally it has changed. I've been talking about a lot more in most of my conversations, one-on-one AMAs that have been taking place, is that central bank buying is the biggest structural shift that has happened towards gold. In fact, 15th consecutive month, China central bank bought, and in the Jan, it now China central bank makes 10% of its total reserve via gold. Right, that's what. Of course, we'll discuss that predominantly in the month of Jan. Overall, central bank was muted. It's only 5 compared to 27, what it has been buying on monthly average. But if you look at the offshoots, for the first time, Bank of Malaysia participated in it. Uzbekistan has continued buying around 9 ton. Your Bank of Korea has finally passed a mandate. They have taken a slightly exception route that entire first quarter 2026, they will be investing in a foreign overseas gold ETF to diversify their exposure. A lot of new central banks are coming in, right? So initially, what was started as a trend by BRICS nation, Brazil, Russia, India, China, Turkey, today you see a lot of new banks participating in this, and this structure is going to remain. Going back to my previous comment of multi-year rearmament, deglobalization, polarization across the globe that you're looking at, I think most central banks will be keen making decent representation of their reserves coming from gold. So make no mistake that gold is here to stay. And what does this does for us from a portfolio perspective, if you look a decade back, Akshay, before 2015, most allocation to gold and silver was touted as 2 to 5%, and that too via multi-asset fund, right? If I have invested around 20% in a multi-asset fund, that will ultimately give me certain some allocation. But right now, I think gold specifically warrants at least a 10% allocation to your portfolio. Of course, depending upon your risk appetite, you can evaluate it. Now, coming to a framework about how the current context looks at it. Uh, right now, what we believe, and I think I'm in sync with a lot of this, that because of uncertainty associated with the rise in dollar index, I think gold will, for next 4 to 8 weeks, probably move in a consolidation territory. You will not see major upside swing. You will not see major downside swing. But predominantly, this can be a great way to accumulate for all those investors who have missed the rally. Again, do not be overexposed to any asset class. But for all those investors who have missed the rally, they can look at it because we anticipate more consolidation to take place for next 8 weeks or so. And the reason is, as I said, you have your dollar also rising up with the crude, right? And still the situation is very fluid, very dynamic. It is changing uh, at every hour. So before the breakout, I think this is where the consolidation is likely to stay place. What will happen? I think a critical factor will be a May 2026 commentary coming from the Fed, when new Fed chair will first publicly make announcements of the Fed policy. It will navigate two things. Right now, market is anticipating a 50 basis of rate cut, but will this crude oil shock sustain to delay that wait and watch mode? And third, and most importantly, market has assumed that the current Fed chair is more of a hawkish in nature. So we don't know how will that pan out too. So I think the breakout is expected to happen that, but till 2029, I think the tail events earlier, what gold was used is to hedge your tail risk, right? Your once in a scenario, once in a lifetime scenario, but now I think that scenario has become once in every year. So from that perspective, an incremental allocation to gold, of course, keeping a asset allocation in mind, continues to make much more case. However, I don't think there will be a very, let's say, offshoot or upbit happening immediately. As I said, because gold is caught up between dollar and the real yield. So till you have a clarity, you'll expect more of a consolidation soon. Gold will continue to hover for next 4 to 8 weeks, and then probably a breakout is expected. Either we have a clarity on the crude price, how they are going to anticipate, or how they are going to affect the inflation part in the US as well as the developing economies, specifically in India, China, or on the front of how the Fed sees in terms of the interest rate delay cut, or they are going to give market what is market is going to anticipate.
And interesting, Vishal. Vishal, since we have spoken about gold, let's also address the other commodity, that's silver. And unlike gold, we have seen that silver tends to be more volatile. We have often seen sharper rallies, but at the same time, sharper corrections as well. And silver at the same time has delivered multi-bagger returns in the past 1 year. But if we talk about the forces, right, like there is good amount of demand coming from new age applications like EVs, solar, and new age like grids. And at the same time, silver has also remained in a deficit since the past 5 years and keeping the overall demand supply equation tight. So, what do you think about silver in the current environment? And especially given the combination of the supply constraint, the demand, and the market volatility that's currently prevailing?
Sure. I think Akshay, first of all, this conversation about supply constraint, I think it has been overplugged and used because silver has been a deficit for a quite long time, not just 5 years. What is very important is the demand is the real structural driver. So, in fact, if you look at last year, it was not only a silver, but solar panel manufacturers, all equity stock. You can go out, check out Invesco Solar ETF in the US. It was for the calendar year 2025 up by 50%, right? On the backdrop of two successive negative returns for the year calendar year 2023-24. So a lot has to do with demand, structural forces, and that for silver specifically, it is very closely tied with what is happening in the China market. So if you remember back in October 2025 in India, also silver was trading almost 25 to 30,000 premium over the international prices. But if you look at what is happening in China, right? I mean, for the first time, the cumulative withdrawal from the Shanghai Gold Exchange for silver physical delivery, it has been at a record high of 436.8 tons. Now, if you go back to 2008, January and Feb combined, the maximum withdrawal had happened in 2021 and 2024. That was 251.9 and 259.4 tons. Now, this is happening very frequently. In fact, if you look at numbers where they are specifically alone in China, specifically, silver is still trading at $12.3 premium over the LBMA benchmark. That's a significant premium, more than or almost 15%, 14.46%. Gold is almost trading at $25 per ounce premium over LBMA. And in fact, if you look at the World Gold Council report, they pointed out for the first time Chinese have held gold more as an investment than jewelry. And what this talks about, and I think if a lot of investors are not aware, so China used to give an export rebate for a lot of solar PV manufacturers. That export rebate is expected to I mean, the government has announced that they are going to roll back that rebates from 1st April onwards 2000. So a lot of solar PV panel manufacturers have front loaded the export, and that's why you're looking this physical delivery and the premiums which are flaring up in the market. Now, what is very critical is as long as your demands for the industrial solar PV panels, photovoltaic cells, that continues to remain, you look at silver doing decently well. However, because silver is ultimately a raw material prices cannot keep on sustainably increasing. In fact, if you look at Silver Institute, Metal Institute, they talked about that on overall basis, they are expecting a 2% decline in the industrial consumption because of the substitution risk. So cost cannot go significantly very high, but at same point in time, I think at this point in time, investors will be relatively more better off in gold than taking a bet on silver. I think silver is best served through an allocation fund of fund that either dynamically or strategically manages, the allocation between gold and silver. In terms of where the levels are for the silver, I think we'll have to see out what happens after 1st April 2026. After the rebates are gone, does the solar photovoltaic cell panel manufacturers, do they continue to pump up the same amount of production? If yes, that means the demand is very robust and they will continue to supply it, predominantly seeing another breakout for the metal. If no, then you can see silver's getting corrected again. So it's more of a right now on the seesaw side. Predominantly, I think the center of attention will be towards gold, rightly so, from a portfolio allocation perspective. We believe silver will be better served through a fund of fund. Individually, when you are allocating, relatively overweight on gold. From a silver perspective, again, now all this takes into consideration is what your allocation, right? If you have been under allocated across the precious metals, the best way is predominantly in staggered manner participate first and foremost. Now, if you are already over allocated, when I say over allocated, it is already forming a part of more than 20-25% of a portfolio, then you may want to discuss with your financial advisor of how do you want to navigate this through. Because if they're going to rise, you're looking at the mark to market movements, right? So it is incrementally increasing your allocation. But if you're not looking at that, where you can accumulate in terms of staggered manner. So I think both gold and silver, predominantly for next 4 to 8 weeks, are expected to be in a consolidation zone. The driving factors are going to be very different. For the gold, as I said, it revolves around where the crude settles around, where the dollar comes in, what is the expectation of inflation in the US as well as the domestically. Because make no mistake, to handle this, if you look at CCIL reporting, RBI has been buying a lot of bonds to maintain the yield curve, right? So that is happening. Whereas on the silver, I think it is not dependent upon post 1st April in terms of export rebate, what is happening. You're looking right now, the withdrawals are looking humongous. I mean, 456 ton, where your average is just 167 odd tons across from 2018. That's a huge amount of inventory being taken off from, warehouse of the exchanges in real. So that is all from the perspective of front loading of the exports. We'll have to see what happens after 1st April 2026.
So, Vishal, as per you, there are multiple headwinds and tailwinds that are going to be affecting both of these commodities. So, for investors who didn't get a chance to, participate in the rally, you said that a staggered mannered approach would be better. Would it be better to take a fund of fund or like a allocation based approach in both these commodities? And like, how should investors think about allocating across these precious?
Hello.
Yeah, I believe there was some connectivity
Yeah.
glitch from our side. So I'll just repeat the question for everyone. As I said, there are multiple headwinds and tailwinds that are going to be affecting both of these commodities. But for investors who didn't get a chance to participate in this rally, would you say that an FOF, like a fund of fund based approach, dynamic allocation approach, would be better than buying these individual ETFs, and what kind of allocation that they can follow?
Akshay, I think firstly you'll have to understand that how much do you want to allocate. Secondly, I think at this point in time, precious metals overall, gold and silver combined makes sense, at least 10% of your portfolio bare minimum. Predominantly, I would like to be more skewed towards gold rather than silver, simply because of the volatility aspect for the silver where it is. If you look at in terms of 3-year rolling return basis, gold has outperformed. In fact, given neck to neck return with equity, because that's what your comparable asset class that you're looking at, whereas silver booms and then bursts. So from that perspective, that's what the allocation is talking about. Second, in terms of a structure, I think, see, you have to answer three questions. First is, can you do allocation yourself? Which means, do you know how to buy, when to buy, how much to buy in gold and silver? Second is, can you transfer? So let's say in individual basis, when I'm making allocation to both ETFs and I'm switching between one ETF to another ETF, every time I switch before 1 year, I'll end up triggering a STCG at the marginal tax rate, right? So can you handle it in a tax efficient manner? If the answer to both the questions are yes, then you can continue to investing in an ETF. If the answer to both the questions are no, which predominantly is for long-term investors, asset allocator investors who don't want to get into the timing part, so we'll have certain set of investors who want to time, specifically looking at the M6 futures, how they are traded, etc. They can of course go to the ETF part, but for all other investors, you can look at the fund of fund as well.
Thank you, Vishal. So just one last question, Vishal. As you said, before 2020, there was the peace era, and post 2020, we are seeing this geopolitical tension spiking up every now and then. So going forward, everyone would agree that geopolitical developments are going to be one important driver for global markets. So in such environments, what key themes or allocations should investor keep an eye over the next few years, or they're building a portfolio for the next 5 to 10 years for like.
Yeah, I think, see, you'll have to be very vigilant in terms of when you're trying to, look at the global macro. See, for the matter of fact, right, everybody's talking about the war and etc. But for a long, Kurdish people have been talking about the autonomous state. So Kurdish peoples are people who share the boundaries in Iraq, Turkey, Syria, and Iran. And a lot of these people have been advocating about, autonomic separate state. Now, what happens is, because of lack of the leadership at the central part in the Iran, there can be rise of a civil war within the nation itself. So we don't know how those situations are very fluid, as I said, right? So if in fact there is a revolt coming around from the Kurdish people for the autonomous region, you look at crude probably going more high, etc. So there are a lot of n number of possibilities. Now, to looking at your questions, I think first and foremost is the defense is a structural theme that I think makes an allocation case. Again, I'm not pointing about making a lump sum, etc. You look at staggered allocation, make it a core part of your satellite portfolio. So let's say you have core portfolio allocation around 60-70%. And simply because this theme is very underrepresented in most of your funds. And the reason why I'm confidently saying about it is because most of them are benchmarked to Nifty 500, Nifty 500 multi-cap 50/50. The representation of these themes are very underrepresented there, right? So you look at that theme being pointed out when you're talking about defense is the key. I think, make no mistake that gone are those days when you are content with 2 to 5% of allocation to precious metal, specifically gold. You'll have to incrementally make around 8 to 10% of your allocation to gold when you're looking at. Now, from short-term tactical view, predominantly, although metal has rallied a lot, but maybe, because of all this commodity cycle, etc., going in around, there may be some squeeze left in the metal part. Again, it's from a tactical allocation that you are looking at. Uh, Broad base, something like, multi-cap or on the active or the passive or even flexi cap will continue to make your allocation. I think at this point in time, in fact, I'll go one step notch and say that. Hello. कर दी. Hello. Yeah, I think there's some technical issue. I think that was the conversation that we wanted to have. We are facing some bandwidth issue.
Am I audible, Vishal, now?
Yeah, you're audible. I think Akshay, we can look at some questions if listen.
Thank you for sharing those insights, Vishal. So we'll now move to the Q&A section. Participants can post them in the chat box. We'll try to address as many as possible. Okay. So there's one question by Ashwini. Suggest some good defense funds. So I believe that Mirae Asset also has an defense ETF as well as a fund of fund, which tracks the BSE India Defense Index. It gives you private plus PSU exposure. You are getting an all cap exposure, both around 60% exposure is to large cap, 40% is to mid and small cap segments. So you will be seeing leading names from the PSUs like HAL, BEL, Mazgao Dock, etc. And at the same time, you'll be also seeing private participants that are not covered in the traditional defense indexes. So you'll be seeing players like L&T, Adani, etc. So overall, you get both a non-demat way, that's the fund of fund, and for investors who are wishing to transact through exchange, they can look at the ETF. So there's one question for you, Vishal. Will gold come down after the war?
See, I think Akshay, if you look at what I talked about, I never said that, there is a rally expected, right? In fact, I use categorically the word that for next 4 to 8 weeks, the gold will predominantly move in a consolidation zone. Any breakout in gold should ideally happen after May 2026. At this point in time, as I said, the expectations of very, very fluid in terms of the markets are very dynamic. So giving a call right now where it is going to look at it, I don't think it would make sense. We never talked about it, right? We have been talking about gold being in a consolidation zone, and that's why a lot of investors who have missed participation in the prior rally can look at it, specifically when it is in a consolidation zone. You don't want to buy asset when it is rising up very quickly.
There's one question by Nitin. Is it better to invest in defense ETF or individual shares? So, Nitin, we believe that an ETF approach is better. I'll give you a straightforward example. Recently, HAL shares had corrected a lot, like when the Tejas news had come out, and post that it has been flattish. So, defense as a whole is cyclical, but at the same time, we saw the other defense stocks rallying as well. If we just compute the same point to point performance, the index or the ETF was up around 5.5%. At the same time, HAL returned flat returns in that same specific period. So we believe for a cyclical segment and like for a cyclical segment, we an ETF approach is better than buying individual shares.
Yeah,
So
and also see, just to add to that, what Akshay is trying to say is whenever you're trying to do any thematic investing, right? Specifically when themes are very nascent in stage, you don't know who is going to be the winner ultimately. So why the whole point is, do you want to bet your entire money on a single horse, or just diversify? From that perspective, when you're structurally bullish on a theme, it's better to invest in the entire bucket rather than trying to pick who's going to be the winner or loser, because the odds of failing is quite high in that. Of course, if you succeed, nothing like that, right? You are, I think Akshay will agree, you'll end up making a lot of a multi-bagger, but the other side is also very true. So if you want to reduce that risk of uncertainty or the severe drawdown, the index is always relatively better approach.
So there's one question by Darshak. What is the current gold silver allocation in our fund of fund?
Yeah, so I think I think Akshay is the fund manager, but where we are looking at it somewhere around, we are relatively biased on gold, around 62% is gold, balanced is in silver. I think Akshay Nisha has a very interesting question. She says, would you recommend only gold or gold and silver investments? Right. I think, Nisha, see, firstly, you'll have to look at where your portfolio allocation is. If you have been missed the entire rally, I think you will be better off relatively starting with gold. First, understand the volatility of gold. Or if you want to participate in both, you can look at in a gold silver fund of fund. Neha is asking which sector are you most positive about? So relatively, we are uh, looking at where the sectors where we are more bullish on the financial services. We continue to be relatively bullish on energy as well. Of course, now we'll have to see how the things pan out. How much of the cost-induced inflation are we looking at? But tactically, metal is something we are, looking at. Next one is what would be a long-term view on silver from 5-year perspective against gold? See, I think 5 year is very difficult to say, but if you look at till 2029 specifically, I think your precious metals should relatively do better. Now, in terms of gold, what happens is if gold even, let's say gold is right now at 5,000, right? International 5,300, 5,200. If it moves even 6,000 in percentage term, that is 20%. Whereas for silver, even if silver touches back its all-time high of 121 from a current price of 92, you're looking at 30%. What is very important is most of your money would have been, if not invested in gold and silver, participated in equity. How much are you expecting in equity, right? If you have an answer to that, then you can look at whether your gold and silver. Now, if you expect that on a domestic equities, you're expecting more than, high teens, then predominantly you will take a negative view on gold and silver. But where if you're expecting a low teens on the domestic equity because of the dollar, because of the FI selling, etc., you can look at gold, silver as a representation in your portfolio.
There's one more question by Santosh Vishal. So he is saying that he has taken Mirasid Gold plus Silver FOF 6 months back and it has delivered close to 80% return. It's around 5% in its portfolio. He's saying that can he make it 10% now at the current level?
So see, if you are investing in gold, silver, so firstly, you'll have to answer that how much are you investing in via multi-asset fund also, because technically you'll have, let's say, even if you have invested a 10% in multi-asset fund, and those multi-asset fund has invested around 12% in precious metals, so roughly you are also adding 1.2% coming from there. So combining this 5 plus 1.2, you're already at a roughly 6.5 to 7% of forming part of your portfolio. Now, from that perspective, you can take it up 3% incrementally in a staggered manner. I don't think there is, a lot of harm. But the only caveat is if you are very exposed to the commodity metals, let's say you have invested in a metal ETF or a individual metal stocks, and those make part of your direct stocks and direct equity, then you predominantly do not want to increase your incremental exposure to the entire metal basket.
So there's one more question by Sarvesh. So he's saying that historically gold has shown a strong inverse correlation with US real yields. So if yields are remaining elevated due to the sticky inflation, how sustainable is the current rally in the precious metals?
Yeah, I think this is an excellent question, and that's what my whole argument for gold being a consolidation zone, Akshay, is because you don't know. See, firstly, what happens is in the US, if you look at the scenario, a 10% increase in crude hardly bumps the US headline CPI, not more than 0.02%. In fact, there's a very good research report that came out. If it is more than 30%, then you're looking at a drag coming on the economy. And most of this, generally, what happens is a lot of central banks generally they pass through a lot of supply side, specifically oil. You look at the core inflation number, which is excluding food, energy, right? So from that perspective, we have to see. But I think it will be too soon to comment that there is a sticky inflation coming around, because again, we don't know how long this war lasts. See, it's very critical because the Strait of Hormuz is very, very important choke point. Any delay beyond 5 to 6 weeks, you're looking at a destabilization happening around. So I think consolidation is what I think is the best scenario right now. Any breakout is expected to take place after May 2026. I think there's a very good question from Anish Akshay. He talked about why should there be a rally in a laggards like HAL irrespective of global scenario. It's just an assembly factory with extremely slow pace. Not all defense stocks should rally, right? Also, is the government taking right decision by investing in only in a very high-end tech? Looking at the Iran factors, we have seen low-cost equipment to create a headache for big boys. I think that's a very good question. So what Anish is trying to say is that you know, and Anish, this is what specifically Akshay categorically mentioned. That's what you aim at when you are investing in individual stocks. If it works, you have probably grabbed the multi-bagger, but your odds, it's just a plain simple maths. You have 50% probability of making it a multi-bagger, 50% probability of wiping out the entire capital, right? So from that perspective, that's why we have been advocate of a thematic coming through a basket. Whether you look at, I think, index, you can look at how it has been constructed, what it has been done, and then make your own call and assessment. That's not a heavy weight on certain stocks that you are looking at. And second is, government is not only investing, on just high tech. In fact, if you look at Mahindra, for example, it's just a low cost armored vehicle that they have been advocating. In fact, India, if is any is a proponent of a low cost, right? We are not the proponents of the very high cost edtech manufacturing that you are talking about. I think from ground till the air, that has been revamping happening across the entire defense. So I think that's what we are looking out. Again, Anish has pointed out, on one hand we talk about de-dollarization, but also gold in dollars. Isn't that a paradox? So that's why, Anish, I think crude, gold, and dollar, they move a lot in tandem. So you'll have to look at how they are moving around. Specifically, ultimately, gold is more closely associated with what is going to happen to the real yield, specifically in the US economy, rather than all these factors. I think Shankar had pointed a very good question. What about passive fund linked to Nifty India Defense? I think uh, Shankar, so I'll just answer it in form of two questions. First is, if you think, so what does Nifty India Defense do? It's a very beautiful constructed index. The only caveat is it only focuses on pure play defense manufacturer. A lot of your defense enabler companies, what Akshay pointed out, the names that have been pointed out. In fact, if you look at the L&T High Tech Precision Engineering segment, it reports predominantly a revenue coming from defense a lot higher than a lot of your pure play manufacturers. So it doesn't have exposure to those defense enablers. So now the key question is, if you want to invest in just who are today's pure play manufacturer, you look at Nifty India Defense. But if you want to invest in really someone who feels like who are going to be your future next decade, and you look at the privatization, the name that Akshay pointed out, it's not the PSU companies that are dominating, right? Lockheed Martin, Boeing, etc. All of those are the private names that you are looking out.
So there's one more question by Anish Vishal. So he's saying that most of the defense enabler companies aren't listed. So I'll also like to point out that we have created, like when we built this index, we had put in a rule. So for any player that is not listed, we'll be taking their parent entity. For in case there is Adani, which is involved in developing drones, so we have taken the parent company, that is Adani Enterprises, in our portfolio. At the same time, there is one more interesting question from Narendra. So he's saying that these rallies are created artificially during geopolitical uncertainty. So that's why restrict yourself to 5% of the portfolio. See, what we are talking about defense right now is a theme that is like going to sustain for the next, as Vishal said, there is multi-year order visibility. We had been an defense importing country, but now we are transitioning into a country that is going to export goods and be a leader in niche technologies. So from that factors, we can say that in the coming decade, India's defense play is going to be very different what it used to be in the 250 or 2015 to 2025 decades. Going forward, public plus private participation, it's going to have a completely different play. And given the allocation, like as we said, the overall spending percentage of GDP, it's still less than the 3 to 5% average. So going forward, it's going to sustain, and that's why we say that defense is a structural theme and should have an allocation as a part of your satellite portfolio.
Yeah, but I think again, I think Narendra, see what you have been pointed out. See, we product manufacturers, right? We have a lot of products. If you and your investment advisors believe that you want to restrict any asset class to 5%, that's your call. Uh, we have a bucket of options available with us, right? That's not our decisions that how much should be your final allocation, that which you pointed out in all investment advisors restrict to 5%. That's what we have talking about. Before 2015, if you look at, in fact, till 2020, most advisors would recommend only 2 to 5% to gold, right? So not only from a defense perspective towards gold, also you see, I think it validates, but ultimately, see, it's very important for you to have your comfort with what you're making the investments, with the comfort with your investment advisors. Since you specifically mentioned the word investment advisors, it's really a decision between you and your investment advisor, distributors, or the financial planners that you're seeing in. I see one more question, Akshay. I'll just take it. Sorry, that we have a defense fund of fund which is not tax efficient. Do you have a defense fund? SK, I think just to clarify, any fund of fund which is feeding into domestic equity ETF, specifically of a mirror asset that you are looking at, uh, are all tax efficient, which means they qualify for LTCG 12.5% after 1 year with exemption of 1.25 lakh. Raman talks about, is it not risky investment in defense index fund compared to active defense funds? I think, Raman, see, the call about active and passive will leave up to you. If you feel the fund managers is rightly picking out the names that he has to, then you continue with the active defense fund. See, in terms of riskiness, anyways, you are already choosing it when you are comparing a passive or active. It is just a medium that whether you're comfortable with a fund manager or with a passive index structure. So globally, Raman, what happens generally, a lot of early stage thematic investments are generally best captured through index investing because you don't know which names will pan out. So the trade-off is you are giving up the potential of, let's say, exorbitant returns, but the benefit is you're relatively trying to protect your downside.
So there's one more question by Harsh. So in a scenario of persistent uncertainty, geopolitical tariffs, debt, and de-dollarization, does gold's structural safe haven status make it a default core holding, or could silver's deficit and demand tailwinds make it a higher conviction play for alpha?
See, I think, Harsh, what will happen with silver is, I think, I'm needless to say, if people who would have looked at all these tailwinds that you talked about, supply deficit, had invested in January 29th, right? They were sitting at a losses of 30%. See, one thing we have to look at, that silver largely is still an industrial play. 50-60% of silver is through industrial, whereas gold, what you're talking about, is a central bank buying. Now, central banks don't buy for trade, they buy with a multi-year investment holding period. When they decide that they are going to buy, they are price insensitive buyers. So a lot of this central buying around 20 to 25% yearly that has been happening across through the different names. It helps providing floor to how much your gold prices can fall. That floor is not available in case of silver. Make no mistake about that, right? You don't have a floor available that this is an X amount of silver that can be bought. Central banks are buying X amount of silver, and that's why this is the floor that we can provide. There is no floor to what your silver prices can fall. Silver floor is exposed to how long the industrial cycle, specifically photovoltaic cell, 30% is made into solar PV panels. It is expected to play. Now, the conviction play for alpha, ultimately it's your call where you are looking at, but we would not advocate that. Gold is definitely a part of your core holding. I think gone are those days when you're making gold as part of your satellite holding. Silver still continues to be a part of your satellite holding. Where to check top 30 holdings of defense funds? I think it is available on our public website. You can look at it, what we are looking at. I think there's a question, defense ETF, is there a minimum limit on investment amount? No, there is no minimum limit. It's available on the exchange. You can do the SIP amount, what you are looking at in terms of trade. I think we have, Akshay, are we missing anything? Is there
Mm,
so an anonymous attendee has asked, is there a physical metal that can be delivered if required? See, technically, yes, but for that, you'll have to come in a check of 25 crore or more. You need to have a same custodian as us. You need to have basically a same bullion trader. So what we don't mind giving you your gold back because ultimately it's your gold back, but we don't want to take the risk of transportation of those metal on the roads. So if you're sharing
we,
the same custodian, same vaulting agent as us, Make no mistake, your gold, if you're coming in a check of 25 crore or above, because that's the SEBI limit, it will be refunded. The gold will be provided to you. I think, Akshay, have we missed anything?
So there's just one last question by Maneet. Traditional gold and silver rise during geopolitical tensions and during declines as safe haven hedges, but lately they have been moving in tandem with equities. Why it is happening and what does it mean for investors?
Uh, See, I think all this correlation thing, right? It's almost, firstly, most of these correlations are always brought from hindsight. Now, if you look, for example, gold, let's take a classic case of gold. Now, you draw any chart, right? Like it's a statistics number. If I plot the number of planet on x-axis and the gold prices, I will end up getting some correlation, to be very honest. But what you have to look at, for instance, specifically in case of gold, if you talk about, central banks never buy gold from 1990 to in fact 2020. In fact, if you look at the overall central buying, it was limited to 2 to 5%. Your biggest demand driver for gold before the Spider Gold ETF was launched, it was the jewelry consumption happening in India and China. So after that, a structural shift came in form of a Spider Gold ETF. Your gold ETF started accumulating 10 to 15 to 20% of golds. And then post 2020, you have now central bank buyings. Now, if you look among all the three key drivers of gold, which is central bank buying, the ETF buyings which are happening, and then you have the jewelry demand from gold and silver, only one Akshay is price insensitive, which is central bank. Because if they decide to buy, they are going to buy irrespective of what the prices are, and that's why the comfort on how much the gold prices can fall. So coming back to your question of this correlation and etc., what happens, you are looking just at a surface number, but you'll have to very importantly assess that your underlying conditions, are they remaining same? If yes, then that correlation makes a lot more sense. If the question is no, there is a structural shift. In statistics we call it stationary non-stationary data points. If there is structural shift happening towards the underlying data, I think you'll need to discount a lot of those numbers which are coming from the historical hindsights.
So there's one more question by Shankar. So if Silver FOF is investing in ETF, what is the advantage of FOF? Can we not invest directly in ETF? So see, the FOF is mainly created for those investors who want to transact via the non-demat route, who are more comfortable investing via the MF route. For investors who are like habitual on investing through the exchange, they can directly invest in the ETF. There's one more question by Neha. Would you prefer buying gold or buying company stocks which sell gold?
Yeah, I think Neha, when you end up investing in a stock of company, what you're doing is you're doing a proxy play. Now that proxy play may or may not translate to, like if you look at classic case of what is happening in India and China, gold prices are up, but your jewelry demand is down because your prices are up, your end consumers are not buying it, right? Because your end consumers are not buying it, so the stock of equity price of those certain set of companies are not going well, right? If you look at jeweler, etc., they have not given an astonishing return because ultimately the consumer is not ready to buy. Again, we'll go back to that three pillars of key demand drivers of gold. It's the central bank that has contributed towards this rise structurally. In fact, the jewelry demand has been tepid. So at that point in time, you may think that you're making a proxy play, but that proxy play may backfire because it's not an exact representation. Yes, the conversation would be very different if you're making investments in metal and mining companies of this, and hardly if you have a largest gold miner listed in India, right? If you look at in terms of metal index, 48% is ferrous, which is steel, 52% is non-ferrous, which is your copper, aluminium, zinc. So you don't have a lot of, sadly, gold mining companies available in India. So I think you'll be better off directly investing in gold ETF or a silver ETF, or buying the bars if you're okay with that, paying the GST, etc. But the proxy play via equity may or may not converge into what you are trying to achieve through your investments in gold.
So there's one more question, Vishal, by Anish. Are there reports of India discovering new gold reserves, true or rumors?
Sorry.
Also, there's one more question by Anish. Are the reports of India discovering new gold reserve, true or rumors?
No, I think Anish will not comment on any speculation. I think that is best left to the government. Yes, the government in the budget has specifically allocated for the rare earth corridor, specifically in the Orissa, etc. But I think apart from that, any comments on the speculation is something we would like to keep ourselves very away from. I think another one, Akshay, is I think it's a very good question. Central bank gold buying has been key driver for gold prices globally. What I have been saying. Under what circumstances do you think this trend could reverse? If rupee continue to depreciate, will RBI maintain the pace of gold accumulation or currency management will take priority? I think this is a very phenomenal question, which has been pointed out. Now, what happens under what circumstances do you think this trend could reverse? Now, firstly, you have to understand whether the global scenario is under a risk on or a risk off regime. Right now, the risk is on. You have a geopolitical tension escalating about, and see, make no mistake. Now, several central banks are acting in isolation. For instance, for last couple of months, Russia, which had accumulated a lot of gold, they are selling gold because they need cash for equipments, defense, etc., to sustain the war that they are fighting. So you may have divergence behavior coming across the central banks within the group. But at the same time, what I talked about, Bank of Malaysia for the first time since 2013-18 started buying. Bank of Korea has indicated it that they will be buying a lot of this, right? Now, for a true risk reversal of this entire that central bank is selling off, I think uh, the probability or the odds are very low. You are talking about uh, predominantly a phase where your globalization comes back, which gets indicated. Let's say US becomes a part of United Nations again. The US signs a Paris Climate Deal, which it has moved out, etc. I don't think it is happening anytime soon. And even if it happens, what central banks will remember is that no matter what, you cannot keep too much dollar because ultimately, if there is an embargo implemented on you, that dollar is as good as worthless. So at that point in time, I think even in those scenarios, certain allocation will continue to remain towards gold. Second is if rupee continues to depreciate, will RBI still maintain a pace of gold accumulation or currency management? Again, even if RBI doesn't maintain the pace of gold accumulation, if RBI focuses on managing the currency, a lot of your other central banks will continue to manage. In fact, if you look at the participation of RBI in the month of Jan, it has not been a great, right? In fact, if you look at last couple of quarters, it has not been very significant. We have been busy in managing the currency, what it has been, but still your overall uptake of central banks are up because a lot of your other central banks are buying. We are a nation of more than 150, 160 countries. So there are a lot of other central banks who can step up. Of course, China, India, Russia, Turkey, Poland, they influences a lot of muscle, but make no mistake that we are not the single drivers of what is being happening around.
So there's one more question by Martin. Defense stocks have seen significant run-ups. Are we approaching a valuation trap or earning projection for 2026 justify current price levels? So see, Martin, what I'll say, if you compare defense valuations on a India level or at a global level, structurally post 2020, defense stocks have re-rated. So on an average, if you, as Vishal mentioned, the Dow Jones US and Aerospace Index, it trades about 2.5 times more premium compared to your Dow Jones parent index. And the same similar trend has been observed in the other parts like Europe, and the same has been followed in India, where there is multi-year order visibility. Investors are now expecting that in the coming time there will be better earnings for these companies. So overall, you can see that yes, there has been a re-rating post 2020. We'll
Yeah, but
take one
Akshay, I think
last.
it's a very fair point that your valuations are not very cheap for the defense. Make no mistake about it, and that's why we have been talking about accumulating in a staggered manner, right? Buying an index rather than buying individual stocks. Because if you look at individual stocks, probably most names are looking at valuation at the top. Now, the only reason why we think, despite this valuations, a staggered allocation can be something that you can look at specifically for the defense part pieces. Because just look at that. If India decides that to meet be compliant similar to what NATO's are, if we decide to increase our allocation to 3 to 5% of our GDP, which I think we should in the coming decade or so, you're looking at a lot of incremental allocation, order book visibility. Right now, those order book visibilities are less. That's why you see the valuation trap that you rightly pointed out. But we firmly believe that across globe there has been a re-rating that has happened. But make no mistake, it's not cheap, so you don't want to invest and lap too much in a lump sum. You want to accumulate as part of your satellite portfolio because it's not well represented in your core MF portfolios, the portfolios that are dominating, right? SK, I think he has asked a very good question. Is that with the SEBI recategorization, that your AMC, basically your equity funds also can buy in gold and silver. In fact, not only equity fund, your NPS can also invest in gold and silver. How much will they increase? I think uh, it's a very interesting question. I think most actively managed, let's say large cap funds. For example, they have a mandate of investing 80% in a large cap stock, balance 20% they can invest wheresoever where they feel like. Now within that mandate comes a gold, silver. I think they'll be more keen on investing in gold. As I said, gold makes a lot more sense in terms of stability, in terms of a relative drawdown than compared to silver. So I think uh, it's net neutral. It's not a negative, but it's not a significant boost. I mean, no matter how much AMC pumps in, all the mutual fund industry, if a central bank decides China central bank and Russia combined decides to sell off the entire gold, then I think no amount of money, how much AMC pumps in buying that 20%, 5% extra will save the fall. So I don't think it's a very significant boost, but it's not a negative also, net.
There's one question by Meet. How about copper investment? Is it a better alternative to silver?
I think, see, copper is a very industrial and very interesting metal, right? But sadly, copper cannot replace silver because, again, silver is the best conductor of electricity. Make no mistake about it. If you just look at the chemistry, chemical property, what silver can do, the amount of copper required to do that same task is humongous. The volume is very high. So I don't think it replaces silver. See, copper is used in all industrial metal. In fact, predominantly it's always the first where copper rallies and then your silver rallies. Silver rallies. But a lot of high-end tech application, data center, AI, photovoltaic cells, they are more sensitive and more prone to usage of silver than copper. That said, companies are doing a substitution risk, so it's not that it's not possible. Now, if you look at in terms of copper, sadly in India you don't have a copper ETF available. You'll have to look at the exchange route if available or the proxy play coming via companies. I think this is Martin has asked a very good question. Is that we are seeing a strategic shift from heavy metal to deep tech in Atmanirbhar Bharat. Which subsector in the defense value chains offer the most attractive risk reward right now? And are the index funds having a sufficient allocation to this subsector? I think this is very beautiful question, Martin. What you rightly pointed out that, and if you look at what has happened, right, even if you look at our war that we had on the Western Front, the Iran war, it's not your tanks, right, that are going in. It's largely your drones that are being used, even in the Operation Sindoor and etc. A lot of these drone manufacturers, if you look at the India's leading drone manufacturer, is a lot of your private company manufacturer, private player. In fact, uh, a listed company subsidiary, which is not listed, it's a incubating company. It was one of the largest provider of these kamikaze drones in the Operation Sindoor. So from that aspect, the portfolio has been very thought about in terms of coverage. If it is available in, let's say, a pool of 1,000 companies, then that is forming a part of the BSC Defense Index. I can say it's from that perspective. Now, what will happen is the portion being in terms of exposure being favorable or not favorable, that has been left for the market to decide because the weightages are based on free float market cap, subject to a cap of 15%. But a lot of your drone manufacturers are forming part of defense enablers, which are forming part of India. But that said, like some companies which are owned by Government of India, like Garuda, etc., they are not part of listed securities. So once they get listed, automatically they will start forming part of the index that has been constructed about. Meet has asked, I think, Akshay, a side question. What is your opinion about factor funds? So again, Meet, if you look at factor investing specifically, I think there has been a lot of factors. We understand what you are looking at. See, factors are cyclical investments, right? So when you are investing in any one single factor, either you take a very long-term view. When I say very long-term view, either you take a 7+ year investment horizon view, or you better cancel out the risk with the other factor. Which means if you're investing in low volatility, you buy alpha to hedge out the risk and vice versa. But do not come into factor in anticipation of returns very quickly. However, what will happen is if you have a patience, factor investing rewards that at exponential rate compared to the linear growth when you are investing in factor funds. Of course, we can talk in more details, etc. You can look at our web page to scout through. I think are gold paper ETFs really backed by physical gold? Yes, Shankar, gold is backed by physical gold. 99.5% LBMA purity golds are there. In fact, Indian regulator doesn't even allow IBJA certified golds. It is only purely used LBMA certified golds, which are bars brought from London, which is used by central banks, etc. Can you advise on Mirae Global Fund so that I can take exposure in international market? We have an outbound fund on the Gift City, which is specifically allocating MSCI World, US, some defense tech themes, etc. A very innovative product. Again, you can look out on the website where you're looking at. I think that's it, actually. I think we have taken most of the questions.
Yes, most of them are done. So thank you all for joining us today. So if there are any more queries or questions, you can visit our social media handles and website for more information. Thank you, Vishal. Thank you, everyone.
Thank you. Thank you.